side. That way I can send it out to you guys once we get done. Now, do you all have any questions from anything we went over on Thursday? I get my days of the week mixed up all the time here. So anything from, let me scroll back up here real quick. Really the key things to kind of want to highlight, make sure you guys have a good understanding of, are the trading session times. Sydney session, Tokyo session, London session, New York session, as well as those currency pairs, the 3-letter designation, the country itself, what the currency is called, and the nickname as well. So, because you're gonna definitely need to know that information going forward. And so tonight, like I promised, we'll be doing some math, not a whole bunch of math, but enough to remind you guys how to use the calculator, the plus, minus, no multiplication, no division tonight. So we'll keep it real simple. But as always, slow me down if I'm going too fast. That way you guys can have it. All right, let's see. I need to fix one thing on this side. I'll give everybody like 2 more seconds to jump in, okay? Okay, let's get started, give enough time. All right, so make sure I hit this record button. Like I said, I'll go slow, but if you guys need me to slow down, definitely speak up, chat in the chat box, and I'll answer all those questions. Record to device. All right, so, and let's do screen share. All right, so tonight I want to focus in on how to actually understand the value of the currencies, and when you're trading, how much you can potentially make and how much you potentially lose while you're trading, knowing when you're buying and knowing when you're selling. So typically, like if you bought a stock you know, you would buy a stock at a certain price at, let's say, Under Armour's price somewhere like $12 a share. And then once it goes up to, for example, $15 a share, you would make $3 a share. So that's kind of the type of math we're going to do tonight. We're just going to do it in the currency markets. Okay. So like we talked about last week, the currency markets, you're going to see two currencies together. On the left hand side, you're going to see the base currency, and on the right hand side, you're going to see the quote. So that first example, the Euro USD, 1 euro is equivalent to 1.0420 US dollars. Okay. Same thing with the second one. 1 Great Britain pound is equivalent to 1.2750 US dollars. So a little over $1.27, right? And then 1 Aussie dollar is equivalent to 0.7510 US dollars. So it's not quite a 1-to-1 ratio there. So we're going to look at some charts tonight a little bit and get our numbers from the chart specifically and calculate our returns and our position sizes that we take in the market. All right, so next slide here. All right. So we'll go down to the slide here. All right, so one of the things in the currency market that you notice the difference is that after the decimal place, we have extra numbers, right? So in the world that we live in, where we're trading or exchanging our money when we go to the store or when we purchase something, we only exchange our money to the 2 decimal places. So you go to the store and the soda costs $1.25. You know, 0.25 is the lowest that we actually use physical currency with. In the foreign exchange market, because this market is so big, we actually trade down to the 4th decimal place. So even the slightest move in the currency change down to the 4th decimal place can be some nice returns when you're trading. So this is what's referred to as the pip. So the pip is the 4th decimal place in the actual quote currency that we just looked at. So 0.0001, that actual 4th decimal place is known as the pip. Now you'll see people talk about they made X amount of pips or for the week or for the month. This is what they're essentially talking about. Now the Euro USD down here, the example is 1.0445. So the 5 is the actual pip value. Okay. Now you also hear something called a fractional pip, and you'll see this on your charts, but it's nothing to really, dive too deep into. But I want you to be aware of it because some charting platforms will show it. Some platforms might not show it. But the 5th decimal place is what's known as the fractional pip or the pipette. And so in this example, 1.27302, the 2 is actually the pipette value. So the 4th decimal place is the one that you really need to know. The 5th decimal place is known as the pip. Okay. Or the 4th decimal place is the pip, 5th decimal place is the pipette. Now, when it comes to the Japanese yen, you guys remember that the Japanese yen was the only currency that doesn't go to the 4th decimal place. This only goes to 2 decimal places. So the 2nd decimal the second position after the decimal is the pip. Okay. And then same thing, the pipette would actually be the 3rd decimal place or the 3rd position after the decimal place for anything associated with the Japanese yen. Okay. Everybody good on that, on the pip and the pipette? 4th decimal place is really what we're paying attention to, but that 5th decimal place, you will see it on some of your charting platforms. So I want you to just know what it is, but you don't have to go all the way down to that specific value in the market. Let me check my chats over here. Why my chat window's popping up on the wrong hand side? I'm looking on the left and chat's popping up on the right. Okay, so you guys are good. Awesome. All right, so now we're going to talk about position sizes. And before I jump right into it, I want to copy this link. That way you all have it. And I want to paste it. I'm actually going to bring it up tonight. Usually I don't bring it up, but because I'm going to show you guys right off the charts tonight, I want to have it up. That way you can actually see it as well. So I'm I'm gonna bring this up and kind of minimize it over here. Okay. All right, so when you're trading the foreign exchange market, when you get into the market, you're basically taking position sizes. So like stocks, you would buy, 5 stocks, 10 stocks, 100 stocks. In the Forex market, we call it position sizes, and they're known as micro, mini, and standard position sizes, okay? Micro, mini, and standard. And what this essentially means is that you're taking these position sizes and they have an associated value to them. So a micro position really means that you're controlling $1,000 in the foreign exchange market. It doesn't mean that you have $1,000 in your account or that you have $1,000 that you're trading per se, but you're controlling $1,000, which is totally different. And we'll talk about leverage. We'll get into it a lot more here. But essentially, a micro position, you're controlling $1,000 in your value in the foreign exchange market. And for each 1,000 position that you're trading, it's worth 10 cents per pip. So as the pip values go up or the pip values go down, the change in pip is worth 10 cents per pip. Okay. If you're trading a mini position, you're controlling a $10,000 position in the market, and each pip change as the pips go up and down is worth $1 per pip. If you're trading a standard position, which is controlling $100,000 in the market, this is worth $10 per pip. So every increment of change, that third column there per pip is how much that increment of change is going to be worth to you. Now, all of these values are associated with the US dollar. So anything that's US dollars associated is this base 10 value. So 10, $1, $10. If you're trading currencies that do not have the US dollar associated with it, for example, the Australian dollar versus the Japanese yen, or the Great Britain pound versus the New Zealand dollar, something that is not having the US dollar associated with it, these values per pip are going to be slightly different, slightly below the 10 basis and slightly above the 10 basis. And that's why I copied this URL so you all can have that to look at and refer back to later. Let me turn this alarm off. Because when you're trading, you definitely want to know how much money that you're risking per trade. Some people, once you get comfortable with it, you're really looking at the actual charts and the position sizes, and you're not really paying so much to the actual pip changes. You're actually looking to trade based on where you think price is going to go, but you already have that predetermined risk kind of built in before you even get into the market. So I want to bring over this chart so you guys can see how this kind of works over here. Now, let me make this as big as I can because I know a couple of you all are on the cell phones here. And let's start with our major currency right here. It's the Euro USD, most popular traded currency. Forgive me for stumbling over my words tonight. Great day. Euro USD. 1.1612 is the price. Now you can see this 10 and this $1 and this 10 cents. If I scroll back up there a little bit, you'll see that's the standard lot position. So every time this thing goes up 1 pip, you're making a $10 increment and change. So you're either making that money or losing that money, depending on what side of the trade you're on. If you're taking a mini position, you're controlling 10,000. If you're using the micro position, you're controlling 1,000. Now, if I look at something else here in the USD associated pair, like the AUD USD, we can see this is all 10 based increments. All right. Scroll down here, see GBP USD, all 10 based increments. So anything associated with the USD is going to be that 10 scale. Anything that's not USD, you want to kind of refer to this particular website. That way you can understand how much each value is going to be worth as you're trading up that specific position size. Okay. So I'm going to come back to this here in a second. Okay. All right. So we're going to do some simple math. And again, if this is not making sense, slow me down and I'll go over it again. So we're going to take the Euro USD in this example, and we're going to say the Euro USD is equal to 1.1220. Okay. The base is the Euro, the quote currency is the USD, and it's going to be associated with the value 1.1220. Now, if the market moves up, where it says exit price, if the market moves up and the Euro USD now becomes 1.1250, that's a difference of 30 pips. Okay. This is going to be simple math. So all we did to get to that value of 30 pips is take 1.1250 minus that initial entry price of 1.1220, and it's a difference of 30. Okay. Now, if we use the same entry price of 112.20 and our new exit price is 111.70, we're going down. So the market's going down. It's still a difference of 50 pips. So no matter if you're adding or subtracting, you're looking for the difference in pip value. So 112.20 minus 111.70 is a difference of 50 pips. Does everybody understand how that works? I'm going to do a couple more of these. Just give me a quick yes if that makes sense for you. So the fourth decimal place is the actual pip. And so we're just doing math. We're adding and subtracting at this point. Does that make sense to you guys? Let me know something, because I will wait until I know it makes sense. If it doesn't make sense, y'all gotta let me know. I don't like just teaching just to be teaching and hoping y'all get it. All right, Sandra says it makes sense. Stacy, does it make sense? L Powell. Okay, I'm gonna keep going. Don't come back to me tomorrow so it doesn't make sense. Because if you guys don't get this point, then as I go through, nothing else is gonna make sense to you. All right, but please let me know. All right, cool. Stacy got it. All right, awesome. Y'all got to respond to me. That's how I teach. You got to respond back to me. So let's take a look at this over here on our big charts. Let me switch this one. Do screen share over here. Okay. So over here on the right-hand side, if you guys have not downloaded the scanner yet, don't worry about it. We're going to go through how to download the scanner and hook it all up and everything. But we're going to take a look at, I don't want to do that one. I want to do a USD pair. That's already kind of worked itself out. Okay, let's work off of this one. All right, so this is the Euro, or this is the AUD USD on a daily time frame. So every red bar and every green bar is one single day in the market. And so we're going to calculate some pip values. Okay. So if you guys have seen the scanner, if you've watched kind of some of the videos on it before, you understand that the scanner basically tells us when to get into the market and when to get out of the market. But we also want to know how many pips that is, so that when we go and take in these trades, we want to understand the value that's associated with it overall. Okay. So I know it's going to be small for some of you all that are on the iPhones and the tablets and stuff. But this initial price down here at the very bottom is 72,145. Again, we're only going to really pay attention to the fourth decimal place. We don't have to really calculate all the way down to that fifth decimal place. So 7214 is going to be our entry price. Okay. Now the first, let me grab a notepad for you guys to make sure to keep up here. All right. And make this really, really big. All right. So our entry price is 0.7214. Okay. Now, our exit price is going to be this first take profit. So basically, this scanner gives you 3 levels of take profit. So you get in at the entry and you can decide either you want to get out the trade at take profit 1, take profit 2, or take profit 3. We're just going to use take profit 1 for now. Okay. So if entry price is 7214 and our exit price for take profit 1 is 0.7393. This is going to be our exit price. How many pips did this market move from our entry price to our take profit price? That's what I want you guys to tell me. So we're going to use that 4th decimal place. And I want to know how far the market went from 0.7214 to 0.7393. So if you got a little calculator, bust out the calculator real quick. If you're good with math, this should be an easy subtraction problem for you guys. I'll give you guys a couple seconds. So 179, who said that? Stacy? Okay. So 0.7393, and then we subtract 0.7214, right? And then let me grab the calculator. I'll make sure everybody sees it when they watch the replay. 7393. 7393. I'm off tonight. Gee. 7214. 179. So Stacy got it. Simple subtraction, right? So now what we need to figure out is if based on that, depending on our position sizes, determines how much money that we could have made in this market. So we're going to take our 179 and we're going to remember that number. And I'm going to bounce over here to this screen again, back to my middle screen here. So we can look at the actual values of these position sizes. Okay. So if we had 179 pips that the market moved, depending on our position size, depends on how much money we could have potentially made or lost. In this case, we would have bought it because it said entry and that says exit, right? So if we had 179 pip move and we took a micro position on a lot, a micro position trade, it would have been a value of 10 cents per pip. So 179 times 10 is equal to $17.90. So that would have made us $17.90 on that particular trade. Okay. Now, if we took our 179 and we had a mini position, that would have been 179 times 1 because we had 179 pips times 1, right? That would have been $179 for that particular trade. Okay. Now, if we had a standard position, 179 pips times $10 per pip, we're looking at $1,790 for that particular trade. So it's nice when the scanner tells us to get in and get out, and we already have our levels that we really just have to plug into the market. But you just got to know the value that you're putting in there. When I show you guys leverage, if you guys haven't got to the leverage part of the videos, you'll really understand that these numbers aren't abstract. Okay. So let's take a look at another example. Let's look at, and again, I kind of want to use something that's already played out in the market. That way you guys can kind of see it a little better visually. All right. Let's get down here. And we switch over again. All right. So this time I want to take a look at the USD JPY on a daily chart. Okay. So again, we're just going to 2 decimal places when it comes to anything associated with the JPY. So we're going to get rid of this. And the entry price that it has on here is 97.57. Okay. 97.57. And now we're going to use, oh gee, I didn't realize this is going to be a lot of math here. I don't think it was going to go that big. It actually gets up, the first take profit is like 108.40. It's a lot. It's a big number. So I don't want to do that big for you guys. I want to keep it simple. You'd have made a lot of money off that one if you took that trade. We'll say that way. All right, let's do USD Swiss franc. So USD CHF. The entry price that it's saying here is 1.0031, okay? And the exit price, the first exit price is 0.9803. So that's going to be our trade, okay? So we're going to basically sell this pair, okay? So same question. Based off the scanner telling us to sell this market, we're selling at the entry, and we're going to get out at this first exit. How many pips is this? What's the pip value difference between 0.9803 and 10031? And I'm going to bring over the calculator so you guys can see it as well. If selling throws you off with going in the opposite direction, let me know. But we just want to know the value, the difference between where we got in and where we can potentially get out. How many pips is that? Play some Jeopardy music for you all. 228, so Stacy. Where are my other two people at? So 1 point minus 228. Okay. All right. I see you guys. So 10031 minus our 9803 is 228. So it's a difference of 228 pips. Good job. Good job. Good job. So if we bounce back over here again, back on over to our middle, we take 228 pips, which is a nice pip move. Most people look for like 50 pips a day, 100 pips a day. You have 228 pips move on this. And if we took a micro position, this would have been times 10, because each pip is 10 cents, right? It would have been $22.80 move. 228 times 1 would have been a $228 move. And then 228 times 10 would have been a $2,280 move, okay? So that makes sense. Let me check the chat. Chat bar went away. Okay, cool. All right, so kind of makes sense to you guys. We're going to be doing some more of those, but again, in the videos, you guys should see that, and then you can see how valuable the scanner is. And then as you're taking these practice trades, these are the ones you want to kind of do. It's very simple to copy the numbers and put them in there, but you want to understand how much the value is worth on those numbers. Now, again, if it's not a USD, then you want to go ahead and refer to the website link that I sent you guys, because the pip value might be slightly different than that based on the current rates of the current pairs at that particular time, because that's why those numbers always change, because the rates of the markets are always changing. So if you were trading the AUD JPY, each pip standard lot might have been worth $8.79 for a standard lot, and not the $10. So okay, if you're trading anything off the USD, definitely refer to this website, because those prices change all the time. It's pretty easy to use this thing. You just put in your trade size. So if you were taking a standard position, it's $100,000. Okay, you can calculate, and it'll give you the pip values over here on the right hand side. So if you guys have any issues with that, definitely let me know. All right, cool. All right, let's get into, all right, cool. We got some time. I want to talk to you guys about leverage. So now that you see the values of the pips, I want to talk to you about leverage amounts. And that way you can see that you don't need $1,000 in your account. You don't need $10,000 in your account. You don't need $100,000 in your account to take bigger position sizes and make those $10 a pip, or make those $1 a pip. You don't need 100,000, 10,000, or even $1,000 in your account to do that. All right. So we need to talk about leverage. And this is the main reason I love the Forex market in particular, is because you can use leverage. Outside of the US, you can use a lot more leverage. Inside of the US, you are restricted. And we'll talk about that real quick. Now, if you trade stocks, then you don't really have that. You don't have that leverage to use leverage, but you can get up to 6-to-1 leverages in some places. So this is how leverage works. And again, if you've watched, it should be in the beginning parts of the videos. And I need some assistance from you all. Let me know how much you all, when you open your real account, don't go open your real account yet, but when you do plan to open your real account, how much money do you plan on funding into your account? Give me some numbers and I'm gonna work off those numbers. That way you guys can see some examples and probabilities and stuff like that. So I'm just quick, 500, cool, nice number. I like that number. All right, 500 to 1,000. All right, awesome. You guys got some money. Last class, they were giving me like $50, $100. I'm like, man, y'all gonna make me work. I can work with 500. Yeah, $50. You make me work, but you can open broker's account for like $10. Just so you guys know, for $500. So we're gonna use that as our starting balance. Now, this is how leverage works. In the United States, we have what's known as 50-to-1 leverage, okay? So basically, for every $1 you put in, you can control up to 50 times that. So that's nice. You can control 50x multiple your money. But outside of the US, you can control a lot more than that, okay? Now, you want to be careful with leverage, especially when you're brand new, but this is how it works. There's some brokers that allow you to control up to 3,000-to-1 leverage, especially if you're starting your account under $1,000. They'll allow you to control up to 3,000-to-1 leverage. But I'm going to use 2,000-to-1 leverage to kind of make this more realistic, because there's a lot of brokers outside of the US that will allow you to trade 2,000-to-1 leverage, at least 1,000-to-1 leverage. You can easily find these types of brokers, okay? So what this essentially means is, if we have our $500 and then we multiply it times 50, I used to be good at math. I tell people, if you're learning the markets, you don't have to be good at math. I keep using my calculator every time I do this stuff, even though I still can't memorize these numbers. 500 times 50, okay, $500 that you fund your account with times $50 leverage that you have in the US is $25,000, okay? So $25,000 is what you're able to control. Let me flip this over to landscape. Okay, cool. So $25,000 is what you're able to control. Now, if I pop back over here to this PowerPoint, you'll see that $25,000 falls in this second range. So it's essentially too many lots of what you're able to control in the market, okay? So even though you didn't have $10,000 to start with, you're able to control $25,000, which is too many lots, okay? Now, if I come back over here, we'll take 2,000-to-1 leverage, so same thing. If we start with $500 times 2,000, we're able to control $1 million in the market. We don't have $1 million, we're just able to control $1 million. So again, come back over here to the PowerPoint. $1 million is approximately 10 standard positions in the market. So even though you don't have $100,000, you can still take that one trade we showed, 228 pip move, take a one standard lot position and make $2,000 off of that trade potentially, and you only had $500 in your account because you're able to control $100,000 based off the amount of money that you put into the market, okay? Does that make sense to you guys? Give me some good yeses, yeses, yeses. I hope that does. So this is how leverage works. Now, the good side to leverage is if you take that 228 pip trade and it goes in your direction, you essentially took a $500 account and increased it by over $2,000 off of one trade. Now, if you trade on high leverage and it goes against you, then you got to keep in mind that that pip value is what you would also lose. Now, if it goes beyond zero, in this case, if we would have had $500 and that trade was a $2,200 trade, but we only had $500, we would have stopped at $500 because the brokers will not let you go beyond that because they know they can't get their money out if you go beyond that. So you'd be in the hole by like $1,500 and they'd be calling you wanting their money. So they close out your positions. Unless there's something erratic that happens in the market where your position doesn't close, like a Brexit type event, or the Swiss franc a couple years ago, they had something crazy going with their economic financial system, and their markets just tanked real quick. Outside of situations like that, your positions will close. So you do want to be aware of the leverage that you use, okay? Let's go back over here. All right. Now let's just see if we can find a simple slight pip move here. If you guys have questions, let me know. All right, 70. Okay, this is a good example. Perfect. All right, so here is the NZD CAD, okay? NZD CAD, New Zealand dollar versus the Canadian dollar. And grab this, bring it here so you guys can see that. All right, so the entry price on here is 0.8785, and then the first take profit level is at 0.002, 0.08827. So somebody let me know the pip value that we increased off our entry point to our first take profit level. So scanner told us to get in at 87.85, and it told us that we can potentially get out at 88.27 as our first take profit. How many pips did that market go in our direction? $42. All right, so if we go, 1 second. I take your word for it. Like I'm so bad at math now. I used to be real good at it. 42, so I'll have to deal with my phone real quick. 42 pips. Y'all think I'm joking? I'm horrible at math now. I'm just good at counting the returns. All right, so 42 pips in our direction, okay? So either that would have been $4.20, $42, or $420, roughly those amounts. Again, this is not a USD pair, so it's not quite the 10 increment scales. We would have to look at the actual calculators to know the exact pip values, but we're just going to keep using the round numbers for example's sake. So let's say this 42 pip move goes in our direction, then we know how much we would have made based on the position sizes we took. But let's say that we had our $500 account and it went 42 pips against us. Let's say for some reason we hit the sell button when the entry came, and we hit the sell button on accident, and it goes negative 42 pips. Now, depending on the position size that you take will determine how big of a loss that's going to be. So if we had our $500 account, let's start a new page, a $500 account, and it was a negative 42 pip trade, and if we took that micro position, which is 10 cents a pip, we would have lost 42 cents. If we took a mini position, we would have lost $42, okay? And then if we would have took a standard position, which is $10 a pip, we would have lost $420, okay? So you can see that you can take a standard position in these markets with small account sizes, but you do want to be aware of the risk associated with it. If you took that trade and it went positive, you easily doubled your account in one trade. If you take that trade and you're wrong, you easily blew your entire account with just one trade, okay? So as you guys are starting to look at the charts and look at the scanner and get the alerts, those of you all that have the swipe trades, you start to get that, then definitely start to look at the pip values of it. So it's safe to say beginners should start with mini pips. Yeah, so you definitely, depending on your risk tolerance is really the key question. So if obviously starting off brand new, you definitely want to practice with the different position sizes. And then once you go to your real account, the rule of thumb is kind of not trading more than 2 to 3% of your account size. So if you have a $500 account, 0.03, so $15 risk per trade is kind of your risk tolerance. But some people have accounts in it, then it really depends on your situation, your financial situation as well. But if you have a $500 account and let's say you want to trade risk $500 per trade, then you could trade it on a smaller broker with a higher leverage because you're expecting to flip that account rather quickly. But if you're trading for long-term slow growth, then you don't want to go over that 2 to 3% of your capital. That allows you to not have to be perfect all the time or try to win every single trade all the time. If you lose 3% one day and lose 3% the next day, and then you win 10% the following day, then you can recoup a lot of those losses. But if you take a trade that's a $500 trade, or you have $500 in your account and you risk half of it, 250, then you've got to make 250 just to get back to break even, and then work towards getting back in profit. So definitely practice first and try to use a 2 to 3% rule as your start with your real account. Because once you use real money, you don't want to be scared in the market if the trade starts to go the wrong way against you. Any other questions? So that's kind of what I want to talk to you guys tonight about, was calculating the pips, understanding the 4th decimal place is the pip, 5th decimal place is the pipette, understanding leverage. So as you look at the different brokers that are back there, US brokers are safe, they're reliable. You have the CFTC oversight on those. You have 50 to 1 leverage. That is the drawback to it, is you don't have as much leverage. But if you have a European broker, then you can have leverage amounts all the way up to 3,000. You don't have to use all the leverage they give you. You can definitely throttle that down, especially getting started with a smaller accounts. You definitely want to use a little bit more, but as you grow your accounts, you want to throttle that leverage back down. Okay. Yeah, what's a good broker to use? I will type those in the chat for you. That way you can just copy and paste. There's a bunch of them. Stacey, you want to know US brokers, or well, I'll give you both. So I'll take US. You want to look at Rwanda. You want to look at Interactive Brokers. They're pretty good. You can look at Forex.com. I want to say, I'm not sure if Trade King still does Forex. And then overseas, you get higher leverage. You just have to understand that if anything happens with an overseas broker, our US government cannot do anything to help you out to get your money back if that broker decides just to up and close shop or anything like that. But some overseas brokers you can look at. Those are the only ones I can think off the top of my head. But definitely check those out. And when you set up your broker account, iMarkets Live, when you set up your scanner, you might want to set it up with the jaforex.com. Open your broker account there once we get there, just because the scanner is built for that particular broker. It works really well, so you might want to use that one for your demo account. You might decide to use it for a real account, or for a real account as well, yeah. But I have both, so you want to have kind of the best of both worlds with it. But yeah, as far as the overseas brokers, you get the higher leverage, but they're not U.S. regulated. They're regulated by whatever country they set up shop in. And if they close their doors, then they close their doors. So you don't want to leave a lot of your money in those brokers unless you're willing to take that risk. So risk is the name of the game with all parts of trading. How much you risk per trade, where you put your money, you got to understand the risk there. Everything is, you want to know the risk behind it. So Stacey says, how many accounts do you have at one time? You want to be able to manage your accounts at one time. Me personally, I have 5 different brokers that I use, but I probably only trade with 3 of them regularly. Just because of that, risk. If one close, even in the US, we had FXCM, which was a very popular US broker. They end up closing, but they shifted all of our accounts to another US based broker. So in those, in those type of situations, it's almost like having multiple bank accounts. If your bank up the street is a local bank and they close, then you gotta, have your money somewhere else. So having multiple ones is nice. Just because you're kind of just diversified. You're doing the same thing. You're still trading the Forex market, but you just have it in different locations. What other questions you guys have tonight? Hope you guys are learning some good stuff. The video should be helping you guys out too. So if you're already ahead of me in some of the stuff on the videos, definitely let me know that as well. And you guys definitely can always reach out to me at any time. I will send out the recording of tonight, either tonight or early in the morning, depends on how fast it takes to render. But if you have any questions as you start to look at the pips and even watching the news, and you can see it on CNBC how it starts at one price and it might close at a different price during the day. Just do the quick math in your head. How many pips did it go up? How many pips did it go down? And then what position size, if you took a micro, mini, or standard, how much would that equivalent to? Now, when we actually start doing some practice trading, the one thing I didn't talk about in here and do the math for is what's called the spread. So it's the difference between the buy and the sell. We'll talk about that and kind of do the math on that. But I really want to do the easy math so you guys can see the buy and the sell, the pip values. And then when we do the practice stuff, you'll see the spread, which is really the cost of doing business. So stock market, you got to pay $6, $7, $8, $9 to buy a stock. In the foreign exchange market, we pay the spread, but it's already taken out as soon as you hit the buy button or as soon as you hit the sell button. So we'll kind of talk about that here very, very soon. So any last questions for tonight? All right, cool. Well, you all have an awesome evening, and same place, same time on Thursday. If you got any questions between now and Thursday, definitely send me a message so I can get those answered for you as fast as possible. So I'll see you guys on Thursday.